Next question. XYZ Limited has following capital structure. Information is given about equity share capital 5,000, preference share capital 3,000, and debentures of 2,000. So there are three sources of the finance that the company has from which it is financing the capital structure. Calculate the overall cost of capital, calculate weighted average cost of capital of the company. That is a question. That is a new point that we have. The question is providing that the preference dividend rate is 15 percentage, rate of interest is 10 percentage, cost of equity is 25 percentage, and income tax rate is 40 percentage. I request all of you to go through the question, please. Everybody is requested to pay attention. Dear students, we have studied that a company is raising the funds from the different source of the finance: equity share capital, retained earning, preference share capital, debentures, term loan, and maybe some other source of finance. Whatever the funds pulled from the different sources of the finance is invested in the business in terms of the fixed asset, in terms of the investment, in terms of the working capital. Like that, say these are the different investments which a company is making. Listen carefully what I am going to speak. Basically, what happens at say you cannot have exactly the differentiation that the fixed asset is financed only with the equity. The investment is made only by way of the preference shares or the debentures. And you cannot have the different rate of the earning say from the different sources of the finance. The business is one only. So we will be having say a single rate at which we have to earn from the business, so that say we will be able to give return to my all fund providers. So this is the concept that we have of the weighted average cost of capital or overall cost of capital. So what happens that say we'll make the calculation of the, listen carefully, cost of individual source of finance, and then we will take into account the proportion in which the funds have been raised. So there are two things that we have. We'll consider the proportion in which the funds have been raised, and second, what is the weight of the individual source of finance. Based on that, so we'll compute the weighted average or overall cost of capital, and that is the rate at which I have to earn from the business. This is the concept that we have of the weighted average or overall cost of capital. I request all of you to write down answer. First one, write down: a company usually raise funds from more than one source of finance. Full stop. Second point: each source of finance will have usually different cost of capital. Third, taking into account proportion in which funds have been raised and cost of individual source of finance, comma, we have to compute weighted average or overall cost of capital at which the company is required to earn so that a return can be given to all fund providers. Full stop. So now friends, first of all, we'll make the calculation of the cost of the individual source of finance and then we'll compute the weighted average. So I request all of you to write down answer along with me. Working note number 1, calculation of cost of debt financing. KD stands for cost of debt financing. No redemption information is given. It means that the security is issued for perpetuity. So we can compute the answer as interest into 1 minus T divided by amount. Amount of the debenture is rupees 2000. Rate of interest is 10 percentage. Income tax rate is 40 percentage divided by 2000. So 10% of 2000 is 200 into 0.6 divided by 2000 once again. So it is 120 upon 2000, 0.06, that is 6 percentage. This is the way the KD cost of debt financing can be found. Or otherwise, in this question it can be found like this also. Rate of interest into 1 minus tax rate. Rate of interest is 10 percentage. 1 minus tax rate is 0.4. 10% into 0.6. That comes to 6 percentage. See, understand carefully. What I want to tell you is that what happens is there is no premium at the time of issue, no discount at the time of issue, there is no flotation cost. In that case, we can go directly with this formula. So these conditions are required to be fulfilled. Only in that case we can go directly with this formula. Because in that case what will happen? This 2000 is getting cancelled against this 2000. And directly we have said this answer. But if at all the securities issued at premium, securities issued at discount, there is a flotation cost, then in that case always you are required to follow this method. So first working note is KD. Working note number 2, calculation of KP. KP stands for cost of reference share. In that case again, there are two things. Either you can do answer as preference dividend divided by amount. Amount of the preference share capital is given as 3000. Rate of preference dividend is 15% divided by 3000. So it is 450 divided by 3000. So 0.15, that is 15%. This is the way you can do it. Or once again, since both conditions are satisfied, one, there is no premium issue, that is a discount on issue, and second, there is no flotation cost, we can say that the KP is equal to preference dividend itself. That is 15% in this example. Right on answer? Okay. After making this calculation, we can have calculation of weighted average cost of capital or overall cost of capital or composite cost of capital. It is one and the same. Column number 1 is amount. Column number 2 is weight. Column number 3 is cost of capital. And the last column is weight into cost of capital. And the first column would be the source of finance. So column number 1 is source of finance. I'm sorry. So we'll have the source of finance in that equity share capital, preference share capital, and debentures. These are the three sources of the finance. Amount of the equity share capital is 5,000. Amount of preference share capital is 3,000. Amount of the debentures is 2,000. So the total is 10,000. Weight or proportion is 0.50, 0.30, and 0.20. 0.50 is found as 5,000 upon 10,000. 0.30 is found as 3,000 upon 10,000. And 0.20 is calculated as 2,000 divided by 10,000. That is the way we'll have the weight, and the total of the weight would be always 1. This cost, for equity the cost is given to us ready-made 25. For preference share it is 15, and for debenture it is 6. So what we will do, weight into cost, weight into cost. That is the way we'll have the weighted average of cost of capital or overall cost of capital to be found. So we'll have weight into cost, 0.50 into 25, that is 12.5. 0.50 into 25. Next it is 0.3 into 15, 4.5. Then 0.2 into 6, 1.2. So what will happen? 12.5 plus 4.5 plus 1.2. That is the way the weighted average or overall cost of capital will be calculated. Please write down answer. So friends, it is indicating the rate at which we are supposed to earn from the business so that we will be able to give return to all finance providers. So we have made the calculation of the cost of individual source of finance. Cost of equity is already given to us, and based on that, say we have computed weighted average or overall cost of capital. I request you to write down answer. So one line answer. The company should earn at the rate of 18.2 percentage so as to give return to all fund providers. That is what we understand.